Hello everybody. Firstly, I'd just like to welcome you to this webinar where we'll be talking about the US dollar and the most important event of the week, the non-farm payrolls, and the opportunities its publication will present. My name is Sasha and I'm a financial analyst from the research department at ForTrade. I'm delighted to have you with us. If you have any questions, please call us and ask to speak to a senior account manager who'll be happy to help. Before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure you know that although gains can be made trading CFDs, losses can be incurred too, and you need to be aware of this. And now let me explain what a market opportunity is if you don't know. A market opportunity is a one-page briefing containing market analysis, and our goal is to provide you with a simple to understand opportunity to trade in the markets. We will select an instrument such as gold or a currency pair and tell you our very best estimate on its price direction so that you can trade on it if you want to. Market opportunities are produced by the research department on a daily basis according to market conditions. A market opportunity consists of fundamental analysis, geopolitical events, and technical analysis that includes a pivot point and support and resistance levels. It's important to understand it's your decision whether you want to trade on market opportunities or not. Here is an example of a recent market opportunity. Here you can see some fundamental analysis on what's going on with the euro-dollar currency pair. You can see that this is a downtrend opportunity over a weekly period, since our analysis suggests the euro would decline in value against the dollar. At the top, you can see some geopolitical events and fundamental analysis that can influence the euro-US dollar currency pair. For example, the part on the EU and its disagreement with the Italian government over its budget, which has put pressure on the euro. When using a market opportunity, it's vital to look at the pivot point on which the calculations are based. In this instance, if the price reaches 1.1381 that you can see on the left-hand side of the screen here, this shows the right moment in our estimation for opening a trading position. That's had you decided to trade on this market opportunity when it was active. You can see below the trend direction and the time period. It's also important that you know how to use the stop loss and take profit options. You have support and resistance levels further along. At these points you can put a stop loss and take profit, and further down you have calculations. If you close the position using take profit, you can expect these kinds of profits at the support levels in green on the top right hand side of the screen. If the price is going against you, then you could potentially have a loss of the amount at the resistance levels in red. Finally, profit and loss calculations are based on a one-lot trading volume. First off, let's take a look at where the dollar stands at the moment, and we'll briefly take a look at the main factors influencing its current value. The dollar has grown in value over the past year against a basket of other currencies. Partly this has been due to weakness in other major currencies. For example, Brexit in the UK has seen the pound fall, and softness in the Eurozone economy has put the euro under pressure. One of the main price drivers for the dollar at the moment is the resilience of the US economy against its rivals. But other main price drivers of the currency include interest rates set by the Fed and the non-farm payrolls report. Over the past year, the Fed has hiked rates 4 times to its current rate of 2.5%. This has supported the dollar. Another factor to bear in mind, which I talk about later, is the trade war. The dollar has been used as a safe haven currency since trade war tensions stirred in April last year. But let's consider the most important factor affecting the dollar this week. So, why is the NFP so important for the financial markets? The non-farm payrolls report is the release of data on US jobs growth over the previous month, and it's published by the Bureau of Labor Statistics usually on the first Friday of the month following the data. It's the most eagerly awaited monthly data by world markets. Morning trading volumes are usually slim in European markets on the day of the release as they await the afternoon release time. The headline number in the report gives the number of jobs that the US economy has gained or lost over the previous month. A more important number for the markets, however, is the difference between the actual change and the consensus of estimates by analysts and economists published in advance. The market reaction will depend on whether the published figure is above or below the consensus, and by how much. So, over the past few years, non-farm payroll data has been very positive. But last month's figures were mixed, as I will explain in a moment. As you can see, the unemployment rate has significantly improved in recent years. The unemployment rate approached 8.5% during the financial crisis, but has fallen since. The unemployment rate has recently fallen slightly to 3.8%. Average hourly earnings is important since an increase in the figures indicates a possible rise in inflation and in the value of the dollar, while a decrease in AHE tends to push the dollar down. Month-on-month average hourly earnings was 0.4% in February. The NFP release comes together with the unemployment rate indicator on the first Friday of every month. When this is due, the trading week is a range-bound one for the forex market, and after the release, traders start positioning for the next time the Fed meets to see how monetary policy changes in the meantime and how to react. When the actual number differs from the forecasted one, the market travels. Usually, traders take positions for the NFP in advance by looking for clues from other economic data, like the ADP jobs report or private payrolls. It's believed that private payrolls and the NFP data are linked in a correlated fashion, but this isn't always the case. The unemployment rate is part of the Fed's decision-making process to move on rates too. Generally, a lower unemployment rate is better for the economy, as jobs are created, and this could result in the Fed hiking rates, and higher rates lead to a higher dollar. There's no such thing as full employment in an economy. By the time the unemployment rate has fallen to below 4%, a labor shortage has already appeared. Experienced traders know this. Forex trading is about anticipating what the central bank is going to do with interest rates at the next meeting. And the NFP is the perfect economic release to position yourself on the right side of the market. So, the previous NFP report. The non-farm payrolls released on March the 8th, 2019 showed that the US economy created only 20,000 new jobs in February. That's much worse than the predicted estimate of 181,000 jobs. The jobless rate, on the other hand, declined to 3.8%, better than the 3.9% expected. So, following the publication of the release on March the 8th, the dollar fell before recovering slightly to finish down 0.12 by the end of the trading day, as you can see on the slide. The NFP result itself was very disappointing, as I said, putting pressure on the dollar. But the good unemployment figures and the better than expected average hourly earnings were enough to keep the dollar from dropping sharply. The markets had a lot to digest with last month's mixed data, and investors decided that the results were unlikely to result in any change to current Fed policy, and thus the dollar's value was not affected to a great degree last month. As far as the euro-dollar is concerned, the currency pair moved higher and then settled up by 0.18% by the end of the trading day. The euro remains weaker in recent months due to sluggish economic performance and the ongoing Brexit issue. But the thing to keep in mind is that the dollar is often volatile on the day of the NFP, but that the NFP can also represent a good trading opportunity. So, what can we expect from this week's report? Economists expect that the NFP will record that 180,000 new jobs were created in March, and that the unemployment rate will increase to 3.9%. Traders would also be advised to keep an eye on the average hourly earnings figures. If they are above expectations, it may push the dollar higher. Average hourly earnings are considered a sign that inflation will rise. You can see that hourly earnings are expected to fall from 0.4% to 0.3%. A fourth interest rate hike last year took place in December. Hikes have been opposed by President Trump, who favors lower rates, but it seems that his constant criticism of Fed officials and fears over an economic slowdown has hit home. Now, most investors believe that there will be no hikes this year, with some even hoping for a cut towards the end of the year, as Fed officials become increasingly vocal that they will pause and wait for the data before deciding on future moves. On March the 20th, Fed Chair Powell stated that there would not be any more hikes this year. So far this year, the dollar has been volatile, but slightly softer against a basket of other currencies, mainly due to Fed moderating its stance on interest rate hikes. But the greenback continues to be powered by a solid economy. So it's certain that reports like the NFP will have a major influence on the greenback and the financial markets. The global economy, on the other hand, has been weaker, which has concerned investors and put pressure on stocks and emerging market currencies. Another factor to bear in mind if you are trading the dollar is the trade war. The dollar has functioned as a safe haven currency, so many investors believe the US is in a better position to ride out the trade war than other currencies. And if you are looking to trade the NFP as a short to medium term move, you should consider that as trade war contentions increase, the dollar tends to increase in value against other currencies. On the other hand, if you believe there will be an end to the trade war sooner rather than later, this scenario would likely influence the dollar downward against other currencies. But the trade war is an important factor, but not the only one when trading on the dollar. And of course, we at ForTrade will be following any developments that affect the markets very closely. So please do get in touch with a senior account manager if you have any questions or want to take advantage of the trading opportunities that the NFP will present. Until next time, goodbye, and please join us again at ForTrade soon.